Together we're going to take a look at the fundamentals of AMD. I'm going to use analysts' assumptions about the future, their EPS, their price to earnings, put it into a stock analyzer tool, make some price targets that you should be paying for AMD, take a look at their fair price, a $122 billion company. This is not a mega cap, but it's a large cap stock. Here on the channel we look at a lot of different companies, and a lot of them are really huge companies like Apple and Microsoft, and Intel is also a mega cap, and Facebook. All these companies are huge companies, and one thing that you really have to remember when especially dealing with these mega caps, so this is not one of them, that is, when a company grows, there's less potential growth ahead of it. It gets harder to grow a company as it gets bigger. It's harder to double Apple than it is to double like AMD. They have a 38 times price to earnings ratio. That is high, and then again there's a lot of growth. That is the multiple that you pay, the premium that you pay for a company. So when this is higher, we will often expect like more growth of the company, higher return on invested capital, better financial position, better sector growth, like things like that. Their 5-year PE is almost 100, so that is very, very high. Reasonable profit margin of 19%, and their price to sales is 7.5. Last year they did 3.2 billion in free cash flow, and that is a lot higher than their 5-year average. But then again, they have been growing tremendously. Their 5-year average is $800 million. They do not pay out dividends, so that would also be very stupid if they did. They have to use all of that to grow the company, because that is what, the whole company is about. Their management is just focused on growth, and that is what they should. This is a growth company. They should be focusing on reinvesting, maybe making some acquisitions if needed, building out infrastructure, building more factories, building more logistics, all these things. That is what this company should be focusing on, not paying out shareholders, because they will be happy with the share price growth. 5-year return on invested capital is actually not incredibly high. That is 10.5, but the past year that has been a lot higher, because they've seen the fruits of their labor starting to pay off here with 41.9% return on invested capital. That is the money that they will generate when you invest into the business. So if you invest $100 this past year, they would have generated around $41 for you, not for you, but for the business that you own a stake in. And in average over the past 10 years, that would have been $10 that they would have earned you. So they have been really increasing their return on invested capital. Is that sustainable? I have no clue at all. So we head into the income statement to see if the company is actually growing. For that, we go back 5 years. Look at the revenue. That was $5.25 billion. Last year, that was $16.4 billion. So they have grown tremendously, over a 3x right there. We want to see that they're actually also growing their profitability, and we go back 5 years to see a negative $33 million in net income. Past year that has been $3 billion. So yeah, went from nothing to $3 billion. That is pretty significant. We want to see their shares outstanding either decreasing or staying the same. If a company has 10 outstanding shares and you own one of them, you have 10% ownership in the business. But if they buy back 2 shares, you still have your 1 share, but that is now 12.5% of the business. They have just increased your ownership, and you don't even have to pay taxes on that. You don't even have to pay anything or do anything. Not like dividends, where that is tax inefficient, and you have to reinvest that unless you have it on autopilot. So there's buying back shares, we really want to see that. And if it goes the other way, they're basically diluting shareholders, issuing more shares. Your share gets worth less. We go back 5 years to see 952 million shares, and last year that was 1.2 billion. So they have been issuing more shares, and this is a relatively they just came out of losing money here for the past decade. So better than taking on debt is definitely selling overpriced shares to your shareholders. A company will oftentimes buy back their shares when they see that their shares are cheap. Basically, when they think, okay, our shares are cheap, they'll buy back shares, because like any person would. Just think of AMD being a person. When you see something cheap trading at very low multiples, then you want to buy. And when you see something trading very expensive at high multiples, you want to sell. You want to sell your shares that the company has and give them to the public. And that is what they're doing at the moment. We will see how bad that is in a moment. But right now, let's continue with the balance sheet. They have 3.6 billion in cash and short-term cash equivalents. They have almost 4 billion in total long-term liabilities. They only have 680 million in total long-term liabilities, and that total liabilities can be paid off with their cash. No, not exactly. They can almost pay off, like short of 1 billion with their short-term cash. So then in a good financial position overall, unless they should like sell out of everything and pay off all of their debt, that would not be possible to do in the short term. So yeah, all in all, a decent financial position for AMD. For the cash flow, we want to see that increasing, and we go back 5 years to see a $100 million loss, and the past year that has been 3.2 billion in the green. So they are now positive in the cash flow, which is a great thing to see. These are the 8 pillars that we use to just get a quick look at a company and see what's up and down. These are the value indicators, this and this one, and that has to do with the price to earnings ratio and the free cash flow ratio, price to free cash flow. And essentially you can see that we want that under 22.5, and that is 97. And this we want under 20, that is 151. The cash flow has just started becoming positive, but they still trade at a very high premium, a very high multiple, because we have seen so rapid them growing so rapidly. We have another X here, which is their shares outstanding. They have been diluting their shareholders in a pretty significant way, with almost 30%. But for the return on invested capital over the past 5 years, that is green, check. And for the revenue growth, massive check. Net income growth, massive check. And their long-term liabilities divided by their 5-year free cash flow is much less than 5, actually less than 1. So they are in a great financial position in the long term. Their cash flow is growing massively, and these massively, this is not a huge number, but these are massive amounts of growth, and that is what you're paying for when you're paying this high PE. They have some excess, and this is why it's very important that we head into the stock analyzer tool to make our assumptions about revenue growth, about profit margins, and about price to earnings ratios, so we get our price target, what we should be paying for AMD. Okay, so the past year they have done exceptional, almost 70% revenue growth. That is not going to be sustainable. We have had some shortage, we have had some insane growth here the past year, and that is baked into the average here over the past 10 years. This average over the past 10 years would not be as high if you did not feature in this last year. So I think that is pretty reasonable right there. We also have some pretty wide spans here with 5%. And for the price to earnings, guys, this is in 10 years, but I will go a little bit higher for this one because it's not a mega cap yet. So I will go, for the high, I'll go 20. And that is higher than I usually do. And I will go 16, 18, 16. I usually go 14, 16, and 18. But here I go a little bit higher, because it's not as big of a company. For the desired annual return, I demand 12.5%. And you'll see what this does here when we hit the analyze button. Yeah, so basically, guys, it's red. And these are not what the stock is. This is not what the stock is worth. This is what you should be paying your price target if you want a 12.5% annual return. The reason I do this 12.5% is because you could get 9 or 10% in an ETF. And that is much safer to just throw it in an ETF than in one individual stock. So essentially what we can see here is we have a mid of $30 a share, a high of around 60, and a low of around 15. So that does not seem very promising, to be honest. What I want to do is use the EPS and my calculator here, EPS by 12 analysts for 2022. Last year they did $2.8 per share in EPS. This year, analysts think that they will do $4. I want to look at what their price to earnings ratio would be if they kept this price for the next year until they did these earnings here of 4.04. 25. Okay. So if they do these earnings and keep this price, if they grow in a year, like in a year, if they keep this price, they will actually be a reasonable price, 25 price to earnings. That is maybe what I'm waiting for. Them doing these estimates and staying at this price of $100. So that is another way to look at it. But still, I want that margin of safety, and I'm not going to get that if I just buy in a year and they stay at this price. I'm not going to get that margin. So let's say they do next year's results of $4.7, and let's say that they stay at the current price to earnings, because it is exceptionally high, this price to earnings. Yeah, they would be a little bit higher, but this is not factoring in that return that you should have. This is just looking at, you know, what the share price would be worth if it stayed at this insanely high price to earnings ratio. And what I think that this company is actually worth is, I think it would be reasonable at a 30 price to earnings. And then I'm looking at not enough return. I think essentially price to earnings is not the only thing that play in, but you can still see why people kind of price it at $100 right now, but still it just looks overvalued if you want a margin of safety, which I recommend. Everyone should always have a margin of safety, but sometimes retail investors, they don't care about that. So, you know, we have had a fall here of 35% since its high, where it was at, what is that? Yeah, 660 bucks. That is just too overvalued. Way too overvalued. If it falls down to these pre-pandemic levels, I'll be a buyer. But that is what I'm doing. I have a price target on this company right now. These are the assumptions that I believe in. I believe in the profit margin of 7, because that is higher than the past 10 years in average. So maybe I even want to go further down than that. I think they could trade at 18 and 10 years, and I think they could do 15%. Yeah, see, my price target is more like that, maybe actually 20, because I'm pretty bullish on this sector. So this is my price target, but it still has to fall like with, what is that, like 70% before I'm a buyer. But notify me, give me an email when it hits that price, if it ever does. I'm okay with missing out on this deal, because then it's not a steal deal, and I only want steal deals. Second of all, the companies that get hit the hardest in times of recessions and fear and people wanting to get out of the markets are these companies. People want to get out of this company when a recession hits, because everything you're paying for is dependent on the future. And if the future is very uncertain, if you've got a recession coming, future is very uncertain. And then people don't want to be in this company. So that is when a 70%, 80% decline in price could be very, very likely if we were to see a recession in companies like this. If you look at a company like, you know, Facebook, that trading at a lot lower multiples, or if you look at a company like Baba, those companies are probably most likely not going to get hit as hard as AMD in a situation like a recession. That is why I stay away from AMD at the moment before it gets to my price target of around $30 to $40 per share. Guys, that was AMD. I hope you enjoyed this video. If you did, make sure to go and like and subscribe. Pull down and click the button right underneath the video here. It takes 2 seconds, and I really, really do enjoy it when you do. And I hope to see you in my next video. Have a great rest of your day. Bye bye.